Recording in progress.
Good morning, everyone. Welcome to the Tax Resolution Help Center. My name is May. I will be hosting today's session and introducing today's speaker. I will also be coordinating the Q&A chat session at the end of the session. I want to congratulate you all for taking steps in dealing with your taxes. Taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax, represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of the wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how
Hello.
much you pay in tax by educating and informing you in ways to reduce past, present, and future tax expenses. We think you are entitled to live a happier, healthier life by keeping more of what you earn and getting the taxman off your back. Our goal is to provide you good information with the opportunity to ask questions that are important to you. The presentation itself will last about 20 minutes, plus 20 to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. To better understand what might be on your mind during the session, I might include some pooling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, this session will be recorded. The topic for today's session is Collection Statute of Limitations. Time is your friend. The tax expert for today's session is Kelly Coughlin. Kelly is a CPA, the chief executive of Everyday CPA and founder of Tax Resolution Help Center. Kelly has been a CPA for over 20 years and has helped countless individuals and businesses remove, reduce, and resolve past, present, and future taxes so they can live a happier, healthier life. Kelly says he loves seeing the relief his clients experience when they get the IRS off their backs. That being said, introducing Kelly Coughlin.
Hello, May. Thanks for the introduction. It's great. We've got a few minutes here, about a 20-minute presentation, and then we can open it up for questions that you'll coordinate. So I'm going to get right to it. Collection Statute of Expiration Date, CSED, as the cool people in the tax business call it. It's a really, 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 that's three reallys, important date to keep in mind if you have past tax debt. Normally in the world of taxes and taxes that are owed, when things don't get addressed, they get better or worse with age. I kind of use the metaphors of when your car is overheating or your toilet is clogged. Very seldom does it do you good to wait and hope that it gets better. Those are two things that don't get better. And the same thing generally is true with tax debt. It doesn't get better with age, it gets worse. Except in the world of the collection statute of limitation date. And this is a date that tax collectors can no longer legally collect from you. I think the notion was this: if people just can't seem to get this off their balance sheet, off their liabilities, for whatever reason, life happens, can't pay it, um, it continues to haunt them. They can't get on with their life. It's like this weight on them. The Congress enabled the tax collectors at the federal level, the IRS, and then state legislatures have a similar provision. They vary from state to state, but they in essence say, all right, if so much time has lapsed and we still have to deal with this, we're not gonna keep pestering and hounding the taxpayer. So that's the expiration date. That's called the CSED, collection statute expiration date. That's the date that it falls off the books. Now with the IRS, that is 10 years from when the tax was assessed. Not when it was due, but when the tax return was filed, or if it wasn't filed, when they assessed that you owed this money. 10 years does not apply for tax for unfiled tax returns. So don't think for a minute that you could delay filing your tax return for 9 years. You file your tax return in 9 years, and then 1 year you get the 10-year expiration date. No, it goes 10 years from when the IRS got your tax return, processed it, calculated it, and said, yep, you owe $10,000. That's the assessment date. So that's a fixed date. And then it starts tolling from there. 10 years from that with the IRS. Different states, I think New York is 20 years. So it varies. Some states don't like to give you relief like that. But the IRS has a 10-year statute. There are some extensions of that kind of extend that a little further. If you've gone through like an offer and compromise where they are reviewing it, and during that period they're prohibited from trying to collect from you, then let's say that takes 6 months, then that extends it. So you'll want to make sure that you know what that date is and get that date from the IRS and make sure that they are doing that calculation correctly, because their systems are pretty antiquated. Sometimes they don't get it right. So, so what does that mean for you? As in, how do you take advantage of it? I have this thing, I call it 3 Ds: determine, delay, or defer. Determine, the first D, determine. Determine if the CSED is a viable strategy for you. Let's talk about when it wouldn't be a viable strategy. And that would typically be, let's just say you filed your 2022 tax return that was filed this year, this spring, by April 15th. The calculation was done. You owed $20,000. The collection statute expiration date would be 10 years from when that gets filed and assessed. That's not really a viable tactic to use to try to use the tax laws in your favor to not have to pay that tax debt. It's just, that doesn't work quite well. That's 10 years. Let's take another scenario. Let's say that this tax debt has been lingering for 7 years now. They've tried to collect from you. They send letters, threatening letters. They put a lien on your house. They continue to badger and pester you. Maybe they've threatened to seize assets, assets that you might not have. Seize your bank account, a bank account that may not have much in value in there. They just can't seem to extract a pound of flesh from you. You can't bleed a turnip or bleed a rock, whatever that phrase is, right? And 7 years has gone by and you've been able to uh, avoid that. Then that's where the expiration date, CSED, can really play in your favor, because now they only have 3 years to collect on that. Now, sometimes they start ramping up collection when they know that this date expires. So there are times you might want to try to buy some more time. It could be you want to go on a payment plan, start out really low. That's the delayed payment things, right? Or you might want to the other D, once you determine that it is a viable strategy for you, then you get into the payment thing. You could try to delay payments. The idea is just to kick the can down the road, because the road's only 3 years now, or it might be 2 years now. If it's 10 years down the road, there's not much benefit of delay. They haven't played their cards yet, but as the date comes approaching, year 7, year 8, year 9, then they're running out of time, and so they're much more willing to do a payment plan to I think they pretty much recognize that, okay, we're not going to get much out of this taxpayer, but maybe we can get something. So maybe you could buy 10, 12 months of payments of, I'm just going to pick a number here, $100 a month. And then maybe you, to get that thing done, you say that, okay, let's start with $100 a month, and then I'll go to $600 a month after month 12. Then month 12 comes along and you go, you know what? I can't afford 600. I can afford 100 still. So, so you keep kicking the can down the road a bit. Then you get into the defer the high payments. That was kind of what I was just referring to. Start with 100. I'm not saying you be disingenuous, but you start out with a low payment and defer the high payments, and you'll need to get your budget ready, and you can't just throw out a number, but you gotta have a budget prepared. I think you can do these things on your own if you plan and anticipate. I'm not here to pitch that you need to get professional help necessarily, but if you're trying to orchestrate a CSED strategy, there's some tactics that you're going to need to have ready to go, like a budget that justifies your payment plan. And there are some guidelines and rules on what they allow in that budget. You can't have $2,000 available for luxury items and purses and shoes and sporting events, if to have that part of your budget. Private school education doesn't work either. So there's some art involved in creating a good budget that will be past the smell test there. So that's kind of how that thing works. It's a great approach to use if the debt is on the books and it's and you want to try to get it behind you, and you can employ a couple other complementary tactics to minimize the amount you're going to have to pay. It could be a payment plan tactic. It could be a offered compromise. It could be a CNC, which is called a currently not collectible. Those two combined, not collectible and CSED, are really terrific. And CNC is, you build the case for why you just don't have enough money to pay it right now, because you don't have any free cash flow to pay this. You can barely pay your own bills the way they are right now. And then they put you in this status where, okay, let's leave them alone for a year or two. and then they monitor your income through your tax returns. And if they don't see a change in your cash flow evidenced by your tax return, they kind of let it sit there. Or sometimes they'll ask you, to confirm or have a conference call with them, and then you can get help with that if you want, just to kind of justify that this is where you still are in the financial scheme of things. And then if you keep it in that status for, let's say, 3 or 4 years, then you're golden. Then you're pretty much in that other model where it's at 7 years or 6 years. You keep it in there for 3 or 4 years, then you're in good shape. Because once you get to year 9, even though it goes to 10, their options are limited there. Now, I have heard, I actually have honestly never seen this, but I'm sure some professionals have seen this, where they will try to get you to extend that